Global trade is dropping off a cliff. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we've been continuously hearing that from policymakers and experts that we're going to see a second half revival in the global economy, and yet the collapse in shipping that started a year ago is suggesting that not only is there no chance of recovery in the second half, but what we're seeing from the shipping industry today says things are going to get a whole lot worse. The notion that we're going to see stagflation is going to be wiped out as we see a collapse in consumer prices, and a surge in jobless claims is coming for the second half of this year. And did the payroll report disappoint? Well, not a chance. We knew that the Bureau of Labor Statistics would validate everything the Fed was doing, but does it mean that we're on track for a second half revival? Well, not a chance. We'll show you why this payroll report is nowhere near as good as the headline suggests. And in yesterday's show, you may have missed it, we featured a sponsor, Shapeways Holdings. In a little over a week, they're going to announce their first quarter earnings. Check out their stock, SHPW, on the New York Stock Exchange. It's making some big moves today, and we think after their earnings, you're going to see some even bigger moves. Let's over to Freightways, where we picked today's story up with a headline, second half freight rebound increasingly unlikely. And this is an important story because when you think about the global economy, we are so interlinked with other countries that the way you can tell the global economy is expanding is through one of the best leading indicators, and that's trade. So when you start to see new order demand pick up and factories start to get revved up to speed again, next thing you know, what you should see is goods starting to move across the world through our ocean highways. And what are we seeing now, at least here from this story, that's not happening at all. Across the physical economy, executives and analysts are projecting the second half of 2023 will be a rebound, as we've said, and that includes containerized U.S. import volumes, which is exactly what we would want to see as it heads into its peak season in late summer to autumn. And some believe the U.S. import demand has hit a bottom. Of course, in our case, we're going to make the case that we haven't even seen the bottom yet because the worst here is quite yet to come. However, further downside risks have emerged for the U.S. economy. It's wrecking the odds of that rebound in imports. And what we can see is container bookings data revealed that U.S. import demand for containerized goods was dropping off a cliff just a few months after Freightways reported that U.S. truckload data first signaled that a freight recession was imminent. Now the freight recession of 2023 has officially arrived. So we're going to go back and look at what happened a year ago. And I want you to see that we have not seen any recovery in the freight state, because we're going to also make the case that the next downturn in freight is going to be ugly and is coming here in a matter of months. Looking at this chart from Freightways, the inbound ocean TEU's volume index, and here what we can see in blue, I've circled last year, you can see that volumes were steadily and strong and rising, and then all of a sudden they fell off of a cliff kind of going into summer, and notably there was no recovery. We just saw the article that says, late summer they want to see a big demand increase. It didn't happen. Now let's look at this year here, what we see in the white line. I've kind of circled so you can kind of focus on that. Notice there's no recovery in global trade on the containerized volumes. In fact, the data suggests that, well, it's kind of on track for 2022's data. We'll go on the fact and say that it's actually underneath that, showing there's absolutely no recovery here. And when we head over to the Fred database, we can pull the imports of goods and services, and we're putting this chart on a year-over-year rate of change because there's something here that I really want you to see is just how global trade is interlinked to broad commerce, the global economy, and when we see a slowdown or outright contraction in it, it suggests that bad things are coming. Now, we could see this coming. I'm going to show you some other leading indicators, and then we're going to look at how this is going to impact the labor market, because what it suggests is there's absolutely no chance of a second half recovery unless we get some sort of boom in trade. I'm also going to make the case why that's not likely to happen either. So here you can see on this chart on the year-over-year rate of change of imports of goods and services, we can note the big collapses, and you can see that in most times heading into those gray shaded bars, which are recessions. What you see is a year-over-year rate of change. It goes to a contraction. That suggests that when you see this, which we're seeing now, that the global economy is decelerating, it's heading down, and likely path is a recession. Now, if we overlay crude oil, we can see kind of the leading indicator here, and we're seeing that today. And one of the reasons I want to look at crude is because, as we talked about in the show the other day, prices have fallen now below 70 a barrel, and that is a critical point because everyone believed that we're going to see energy prices soar. We're now seeing them head the other way, and again, this is another proxy of global economic demand, telling us that something is seriously wrong going on in the global economy, and it's validated here in this chart. As you can see, crude oil on a year-over-year rate of change tends to lead imports of goods and services, particularly to the downside and to the upside. So what crude oil is saying here is, look, if you're looking for a second half recovery here, so far we see absolutely no signs of it. What we'd want to see is crude oil prices rallying, suggesting that demand somewhere underneath the global economy is starting to percolate up and create some more excitement. We're not seeing that at all. In fact, crude is telling us just the opposite. If you're looking for a recovery, you're not going to find it anytime soon. And so what does that mean for consumer prices? Well, as we know, imports are a big factor in U.S. consumer prices, suggesting they too are headed lower. Now, I know many people don't believe that we're going to see further disinflation. It seems to be a popular view that inflation is going to remain sticky, but here you can see the imports of goods and services overlaid with the consumer price index, that shown in red, and you can see that there is a wonderful relationship between these two. It tends to be where import prices go, consumer prices tend to follow, and what you see now is import prices contracting, suggesting that consumer price inflation is headed right toward that magical Fed target of around 2%, could be to the high side of 2.5%, but is headed that way and is headed there relatively quickly. So again, we start looking forward to Fed policy. Will they pause in June? Most likely. Again, the Fed thinks they're going to raise rates and hold them there. We think that that this is a last hike and they're going to cut them. But I'll let you decide. What do you think? Does the freight data telling us what we know to be true is that global economy is headed into a massive recession? Or is the Fed going to somehow pull this off and keep rates up? You let me know in the comments. But as we turn to the new year, the other factor here that almost everyone's overlooking, we see the inventory glut carried over from 2022 by U.S. importers was one of the primary headwinds against import demand. And it makes sense. If you've got a retail store or you're a wholesaler and you've got inventory and you can't move it, well, guess what you don't need? You don't need to put in some new orders unless it's seasonal stuff. You know, things that you might need that you don't have. But beyond that, you don't need to put out a lot of orders because you need to clear through your inventory. We said this was a problem, and that's another factor that's feeding into this freight demand collapse. And here we can see the continued difficulty U.S. importers are having in burning through excess inventory is being exacerbated by weakening consumer demand. And that is not what you see heading into an expansion. They go on to say the latest credit card data from Bank of America reveals may already be happening. In the latest report, BofA wrote car spending per household fell sharply by 1.5% month over month in March. We forecast a below census 1% month-over-month decline in the Census Bureau's retail sales, excluding auto figure for March. And of course, another factor, one of my friends mentioned just the other day, he said, Steve, what do you think is going to happen when, of course, the student loan repayments have to come back? At some point, they're coming back. It's going to be a huge crushing blow to demand, as many people aren't prepared to start making those payments again. They're going to have to make major adjustments to their budget. And of course, it's going to lead to a further decline in discretionary spending and a further collapse, and of course, freight volumes. But how does this all portend to retailer inventories? Here you can see imports of goods and services as they collapse. Of course, we know retail inventories, they need to come down. They're shown in red here on a year-over-year rate of change. And it's not until retailer inventories get into a contraction where they're eating through their supply, as you can see here. Once they've gotten through that to a level they feel is now comfortable, then you see imports rising, suggesting that this huge inventory glut is going to be a further drag on the global economy. We effectively overproduce. We don't have enough demand, and even worse, demand here is getting worse. And now we're going to turn to one of the largest shipper, and here's what they have to say about the shipping industry heading into the rest of the year. It's going to be bumpy as the world's largest container shipper warns of a downturn. And Metre, which transports close to 1/5 of the world's containers, is from Zero Hedge, beat expectations in the first quarter, but said, hey, will be the best quarter of the financial year. And there's some good reason they're saying that. I want you to see this is really key because the chief executive talked about a large influx of new vessels about to hit the world's top shipping lanes that were ordered during the last several years. So what do we expect these ships to be? Big and bigger, and even bigger than that. There's going to be massive container ships. And so what does that tell us? We're going to have a big open amount of ships that can handle all this cargo. So what do you need? Well, you need supply to go along with the demand. Well, we have the supply and the shipping. We don't have the demand for economy. For what I want you to think about, what does this mean for container rates and shipping volume prices? It means they're headed down. And that, my friends, is not inflationary at all. And he's going on to say that there's going to be quite a few coming this year and quite a few coming next year. Volumes are coming back after, but it's not like the macroeconomic backdrop points to a lot of growth to take care of this, telling us there's going to be too much supply in the container ship market. And notably, what do we see here? An absolute collapse in container ship pricing. This will likely go further down because we're going to have far too much capacity and not enough demand to fill it. And one thing that we do look for demand from, of course, we want to see a collapse, and that's the CTA-Timer Pro report. Now, mind you, it's still $30. We're looking at raising that to 40 soon. But what this does is a really cool report, and I got an email from one of my fans and subscribers today. He said, Steve, this is the easiest report I've ever used. It helps me find when things are at super low points. And he's like, I've just had a lot of success using this, and I really appreciate it because what it does is it looks at the computer models, and then it runs a historical overlay. So when this thing is telling you something low, it's on a historical basis. You want to start buying low and selling high. This is a report. And for those of you who are subscribers, be sure to log in this weekend. We put out a weekend watch list of some of the top picks that are on their way down for you to find for a reversal to the upside. In a separate interview, the CEO told Bloomberg that still there's a lot of uncertainty ahead as global business activity slows and companies race to reduce inventories at warehouses due to overstocking. There it is, too much inventory during the pandemic years. In return, demand for container ships have sunk on major shipping lanes. The downturn in shipping began in late 2021 when rates topped out. So here again, we're going to see further collapse in not only imports and global demand, we're going to see a collapse in pricing and shipping. It's all going to put disinflationary and at some point deflationary pulses into the economy. By the way, the link for the CTA-Timer Pro report in the description below. And here you can see how this is now going to lead to an increase in layoffs, because you think about this, if there's too much inventory and not enough demand, what happens, right? New orders go down. We know that. If new orders go down, factory demand goes down. What have we seen? A slowdown in the factory sector, not a huge one yet, but we've seen it. Then what do you see in the global shipping? A slowdown. Well, if you have all these slowdowns, well, what do you need? Or what you don't need is a lot of employees. And here you can see the imports of goods and services against the 4-week moving average of initial claims. And what do we know? That slowdowns in imports lead to an increase in unemployment claims. You can see it's across the board in every certain time. So notably, this downturn in imports suggesting that this trend higher that we're seeing in the labor market, of course, we'll talk about the payroll report here in a moment, is suggesting that unfortunately more layoffs to come, and that does not give us any indication of a second half rebound. It tells us a second half recession now becomes the base case. As we turn to FedEx, even they're validating there is a slowdown. As FedEx Freight to close 29 service centers. Now, let's say it's drives efficiency, but if there was demand for global trade, they wouldn't do it. Now, they're saying this furlough of their employees is only for drivers is only for 90 days. They're saying this is temporary, but what's notable here is this is part of a slowdown as they adjust their capacity with slowing demand. There have been multiple driver furloughs, but my guess is there's going to be even more. Now, if you're in the shipping industry, maybe you work for FedEx or UPS or someone else, are you seeing the slowdown in your business? If it is, please drop us a note or if you don't, drop us a note in the comments. Love to hear what you're seeing as an insider, because we head over to Germany, we see an outright collapse in German factory orders. And this is again telling us demand is crashing. You look over this, one of the biggest declines post-pandemic, minus 10.7% month over month for March. And of course, if that's any indication of what's coming to the rest of the world, well, we are indeed in big trouble. But of course, we know that the Bureau of Labor Statistics will always have the Fed's back. But is today's payroll report as good as the headline number suggests? Well, not a chance. As U.S. job gains and wages pick up, signaling labor resilience, and payrolls broadly increased in April after what? Downward revisions. Non-farm payrolls increased 253,000 after downwardly revised 165,000 advance in March. The unemployment rate fell back to a multi-decade low of 3.4%. Again, validating all the moves the Fed just made. Again, you see that, hey, we're going to raise rates. Everyone's saying, no, you shouldn't. The bond market saying, you better not do it. And then the Bureau of Labor Statistics says, hey, buddies, we got your back. Look at this report. And now all of a sudden, everyone's saying, well, maybe the economy's getting too hot. Not a chance. The job growth was broad-based, reflecting gains in healthcare, professional and business services, as well as leisure and hospitality. But get this, the prior 2 months of payrolls were mysteriously revised lower by a combined 149,000. So again, you gotta love what the BLS does here. And this isn't intentional, but they put out a number and then they revise it. And well, it just so happens we're revising it down, but suddenly nobody seems to care about that, because you can see the revisions going back to January, February, and March. These are the total revisions, bringing that down in this chart from zero hedge, as the latest figures underscore the resilience of labor demand despite growing concerns about the toll of high interest rates, inflation, and tightening credit conditions are projected to take on the economy. While some businesses have paused hiring or laid off workers, others are still boosting pay, but not nearly that much. And here we can see that even though we're seeing a positive payroll report, now this is shown on a year-over-year rate of change. We've got the non-farm payroll in blue. I couldn't show it the way I ideally wanted, only because the pandemic data just skews it on the chart so you can't see it. But what I want you to notice here is you can see the 4-week moving average of initial claims rising, even as the year-over-year rate and change of the non-farm payroll report remains positive. So everyone running around saying, hey, look, we got a positive payroll report. It doesn't matter. You don't tend to see payrolls turn negative until sometimes during the recession. You can see even middle or late stage recession, you see this thing turn negative. But what we do note is average hourly earnings, and now for the first time, the consumer price index are now about at parity. But notably, what I want you to see here is average hourly earnings, that's shown in blue, turn down. They tend to turn down, well, during those gray bars, and that suggests recession is coming, which is what the shipping industry has been telling us all along. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.